We're going to look here at 614 and 616. 14 is calculation for depreciation. How do you calculate depreciation on a truck that you purchased? Guys, this is a $17,000 truck, and we have a salvage value of $18,000. We have a useful life here of 4 years. So we basically take away the salvage value and divide it by 4, and we're going to get an amount. And this amount is how much depreciation we would take per year. That's how much depreciation expense we would take per year on this particular truck. Now, if you take the truck amount that you originally paid for the truck, which is $17,000 in this case, and you subtract out the accumulated depreciation on any particular time, you're going to get what is referred to as net book value. So net book value at the end of the 3rd year, okay, would be 117,000, excuse me, minus your amount per year that you're depreciating times 3. So you would be left with 42,550. Now, if you'll take special notice that this amount right here, 42,750, is 24,750 plus the salvage value. So that's what's left here. And then when on the next year, if you were to take another year of depreciation, then you would have a net book value of 18,000 when you use straight line. So if it was net book value at the end of the 4th year, you would have a book value that was equal to the salvage value. Double declining balance takes straight line and kind of doubles the rate. In other words, you can find out the straight line rate by taking the 1 and dividing it by the number of useful years. So if the number of useful years were 5 years, it would be 5 into 1, which would be 20%. But in this particular case, it's 4 into 1, so it's 25%, and we just simply double it and use 50% for double declining. Now, what I want you to realize too now, is don't miss this in the chapters, that there is generally accepted accounting principles kind of in this case allow for companies to either do straight line or double declining. And this gives companies an opportunity to maybe have an asset that they know they're going to use a whole lot in that first year, and go ahead and just accelerate most of the expense. And also it saves the company money, because if their income is less if they go ahead and expense it. So sometimes these smaller companies are just using double declining for their tax rates. And although if it's any substantial amount of money now, the federal government has their own depreciation acceleration that they will allow for companies. And of course, if you were taking a tax class, they get into all that, but we don't have to do that here. But just know that GAAP will accept either straight line or double declining, either one or the other. If you scroll down here and see how this is calculated, we take the 117, which is the full amount without the salvage value now, and you multiply it times 50% and get 58,500. Now, that first year, look at that contrast between the first year here, straight line, and the first year here, 58,500 for double declining. You see, that is an accelerated amount of depreciation that you're taking. And of course, since it's 50%, the accumulated depreciation is also 58,500, and the net book value is as well. So notice you take the net book value in the 2nd year and multiply it times 50%, and that gives you a certain amount. And that amount now you see is still above how much you would take with straight line. So you take more depreciation in year 1 and 2 and a lot less in year 3 than you would for straight line. Okay. So we get over here to accumulated depreciation, and we just take the 58,500 and we add this 29,250 to it and get 87,750. And that means the 117 minus the accumulated depreciation of 87,750 gives you a net book value of 29,250. And then we take the 29,250 down here and use that at 50%. Now when we do that, we've got an amount here, 14,625, but there's a big hashtag next to it, and there's a reason for that. We can't bring our value of our piece of equipment here, our truck, down less than what the salvage value we estimated it would be. So we're limited. So if you'll come down here to this hashtag, and you'll see that we are going to limit this 14,225 of expense to 11,250, which brings our accumulated depreciation maximum can be is 99,000, because 117,000 subtracted with 99,000 will give you 18,000, which is equal to the salvage value. So just remember, in year 3, the salvage value came into play with double declining depreciation. And you'll notice too that you're all depreciated out in the 3rd year with using double declining, because you front loaded your expense then in those 3 years. Whereas with straight line, you'd go on for 4 years and you would continue to depreciate this item. So remember, in double declining, we depreciate to the point of the salvage value. So keep that in mind as you begin to make those calculations in the homework. If you go over here to 616, now this is just calculating the present value of an amount of money. In this case, 100,000. We got 5 periods. We got an annual rate of 16%. And so we went to table 6.4 right here, table 6.4, and we got this factor, 4761. And they multiplied it times the 100,000 to get the present value of this particular amount of money over 5 years. The reason I say years is because this is an annual rate, that's 16%. Right? Now, since in A, it starts to throw you some twists, right? It says, wait a minute, we got the same scenario, but we're compounding twice a year. That means interest is compounding twice a year, means that the present value be a little different. So what we want to do is we want to double then the amount of periods that we're looking at in table 6.4. You'll see that here is 10. And then we'll want to take the interest rate and bring it to whatever the period is. So you're matching the interest rate to the period. So it's 10 periods then, which is really 10 half years. And then we compounding at 8%, which is 1/2 of the annual rate. And then we get a factor from the 6.4 table of 4632, which gives you a different present value you'll see here. And then guys, it could also be that you are compounding quarterly instead of semi-annually. And if you were to do that, then you would then take your number of periods and make it 20. And then you would divide 16% by 4 quarters to get that 4%. And then you would look in the columns on table 6.4 to get this factor, to get a different present value once again. So I want you to realize that I'm very aware of the fact that students can use a financial calculator, and a lot of my students know how to do that. But I have found that a lot of my students don't know how to do that very well. And that's fine too. Guys, you can use a simple calculator and use the tables in the book, and you can come up with a present value of 1 factor, so you, in whatever scenario you're given and whatever you need to do. The most critical point here is being able to go into Connect and just make sure that you know how to input it into Connect in the appropriate way, whether you're using a calculator that is a financial calculator or using a simple calculator with the tables. I know those work a little easier, I think, into inputting into Connect, so that we know how to calculate present value. In C and D, The interest rate just changes. The periods of time stay the same. They're still annual rates, and you're getting the present value for those. In E and in F, they're keeping the 16% rate the same, but they're changing the periods on you. So you're looking up a different factor for each one of those and getting a present value based on different scenario. Okay. So what I want you to do is I want you to figure out how to do this in Connect. And the algorithmic problem will let you go in and do this time and time again, so you'll know exactly what Connect will accept. And then you'll be fine with this. This is a real easy calculation and real easy table to use. So just go to the table and get familiar with it. And remember too that you'll want to know what page those tables are on, because you're going to have access to your ebook while you're taking the test, which gives you access to the tables, and you might need those. And you're going to be able to have scratch paper and a calculator and pencil and all that while you take the exam. So just making you aware though that every software application is quirky when it comes to input, and Connect is no different. So you got to go in there and figure out how to use it. And so you can do that, and you'll be fine with it. But I'm just giving you a heads up.